For years, Russia existed on the edge of global finance, vast, powerful, resource-rich, yet strangely distant from the world's economic core. Investors spoke of it cautiously, often dismissively. Too unpredictable. Too political. Too risky. And then, almost overnight, that perception shattered. It didn't happen with a single headline or a dramatic announcement. It happened quietly, across trading floors and boardrooms, when numbers stopped adding up. Capital began moving. Energy prices reacted. Currency markets stiffened. And analysts across Europe and Asia reached the same uneasy conclusion: Russia could no longer be ignored. From London to Hong Kong, portfolios were suddenly exposed to decisions made in Moscow. Energy-hungry economies watched nervously as pipelines became leveraged. Sanctions, once theoretical, turned real. And a country long treated as peripheral revealed itself as central not just politically, but economically. For ordinary Russians, this shift carried weight beyond markets. It reshaped wages, prices, and the future they imagined. For the world, it raised an uncomfortable question: how did global finance underestimate a nation this deeply connected to energy, security, and power? Could this happen again to another country overlooked until it reshapes the system? If stories like this fascinate you, subscribe to join us as we uncover hidden global truths. And tell us where you are watching from. For much of the post-Cold War era, Russia occupied an uneasy space in global finance. It was vast, nuclear-armed, and rich in resources, yet treated by investors as an afterthought. Capital flowed instead toward faster-growing markets in Asia or safer institutions in Western Europe. Russia, many believed, was too political to trust, too opaque to model, too volatile to anchor long-term bets. That perception wasn't entirely unfounded. The memory of the 1998 debt default lingered like a financial ghost, shaping risk models and boardroom conversations for years. Western banks remembered the losses. Traders remembered the shock. And so Russia was priced not as a pillar, but as a wild card, something to hedge against, not build upon. Yet beneath that skepticism, a different reality was taking shape. Oil and gas revenues surged quietly through the 2000s, filling state coffers and stabilizing public finances. Moscow paid down debt. Reserves accumulated. Infrastructure expanded. The numbers improved, but the narrative didn't fully catch up. Across Europe, energy dependence deepened almost invisibly. Homes were heated by Russian gas. Factories ran on Russian supply. Contracts were signed, renewed, normalized. Analysts noted the trend, but few framed it as systemic risk. After all, markets had grown comfortable separating economics from geopolitics, assuming trade would neutralize tension. Inside Russia, confidence slowly returned. Wages rose. Consumption followed. A generation that had known only instability began to believe in permanence. And yet, somewhere between spreadsheets and pipelines, a question remained unanswered. What happens when a country the markets misread realizes how central it truly is? By the early 2010s, the gap between perception and reality had grown dangerous. Russia was no longer fragile, yet it was still treated as peripheral. Global investors enjoyed its resources without fully pricing its influence. Energy markets relied on its output. Commodity prices moved at its rhythm. And still, risk models assumed stability without confrontation. Then, the signals began to change. Political decisions in Moscow grew more assertive, less deferential to Western expectations. Diplomatic language hardened. Strategic priorities became clearer. For the first time in years, analysts began revisiting assumptions they had long left untouched. Could markets really remain insulated from geopolitics when supply chains, energy security, and capital flows were so tightly bound to a single state? In Brussels and Berlin, quiet concerns surfaced. Energy dependence, once framed as mutual benefit, now looked like exposure. In Washington, policy circles debated whether sanctions were symbolic tools or economic weapons capable of reshaping global behavior. Investors watched these discussions closely, sensing that political friction was no longer background noise, but a leading indicator. Inside Russia, the mood shifted as well. Economic strength fostered confidence, but also defiance. The belief grew that Russia's role in the global system granted leverage and that leverage could be used. Markets, however, were slow to adjust. Capital remained committed. Contracts stayed intact. Optimism lingered. But history shows that markets often recognize turning points only in retrospect. The moment of realization was approaching not gradually, but suddenly when investors around the world would be forced to confront a truth they had long avoided. Russia was not just part of the system. It was one of its pressure points. The realization did not arrive all at once. It unfolded through a series of moments that, in hindsight, felt inevitable. A sanctions announcement here. A sudden shift in energy prices there. A market reaction that seemed disproportionate until it wasn't. Gradually, then abruptly, global investors understood what had been hiding in plain sight. When geopolitical pressure intensified, capital reacted before speeches did. European energy markets stiffened. Futures contracts swung wildly. In Frankfurt and Paris, traders watched screens flash red and green in quick succession, trying to price uncertainty that no model had prepared them for. Russia's role was no longer theoretical. It was immediate. Across Asia, import-dependent economies recalculated supply chains overnight. In Tokyo and Seoul, officials studied contingency plans once considered unnecessary. Even in distant markets, portfolio managers realized that exposure to Russia wasn't confined to Russian assets. It was embedded in energy, agriculture, shipping, and inflation itself. Inside Russia, the response was measured but firm. Currency controls stabilized the ruble. Domestic systems adjusted. The message was clear: isolation was costly, but not crippling. For markets, this was the breaking of a long-held assumption that economic pressure would produce instant collapse. Ordinary people, on all sides, felt the shift differently. European households noticed energy bills climbing. Emerging markets absorbed price shocks in food and fuel. In Russia, consumers adapted to scarcity and substitution with a familiarity born of history. What markets were confronting was not just a country under pressure, but a system revealing its own vulnerability. Global finance had treated Russia as marginal and now discovered how deeply it was woven into the world it helped shape. As pressure intensified, the global response became more revealing than the event itself. Markets that once moved confidently now hesitated. Volatility replaced certainty. In London, fund managers reduced exposure not only to Russia, but to any region connected by energy or trade. In New York, inflation forecasts were rewritten almost weekly as commodity prices refused to settle. Across Europe, political leaders faced an uncomfortable reality. Economic interdependence had created strength, but also fragility. Energy security became a nightly headline. Citizens who had never followed foreign policy began to feel its weight in household bills and shrinking purchasing power. For many, geopolitics stopped being abstract and became personal. In emerging economies, the consequences were sharper. Food and fuel costs climbed. Currencies weakened. Governments scrambled to shield populations from forces they did not control. Analysts in Africa, Latin America, and South Asia spoke openly about second-order effects. Russia was not just influencing markets directly. It was reshaping the environment in which everyone operated. Inside Russia, the economy adapted with discipline and restraint. Trade routes shifted. Domestic production filled gaps. The narrative of collapse gave way to one of endurance. This, too, unsettled investors. The expected outcome had failed to arrive. What the world was witnessing was a recalibration. Capital was learning slowly and painfully that power in the modern economy does not always sit where markets expect. It can exist outside financial centers, embedded in resources, geography, and political resolve. The realization was complete. Russia was not a side story in global finance. It was a force capable of bending it. And the consequences of that understanding were only beginning to unfold. With time, the urgency softened, but the lesson remained. Markets adjusted. Supply chains rerouted. New assumptions replaced old ones. Yet beneath the recalibration lingered a deeper realization that numbers alone had never told the full story. Russia's weight in the global system was not simply economic. It was structural. Geography, resources, history, and political will combined into a form of influence that could not be neatly modeled or easily discounted. Investors had spent years pricing efficiency and growth while underestimating leverage and resilience. Across Europe and Asia, policymakers spoke more carefully. Diversification became strategy rather than theory. Energy security transformed from a technical discussion into a national priority. For many governments, the episode exposed how comfort had bred complacency. For ordinary people, the shift felt quieter but no less real. Higher prices lingered. Expectations adjusted downward. A sense of permanence gave way to awareness that stability could be interrupted by forces far beyond domestic control. The world had not just learned something about Russia. It had learned something about itself. About how global systems reward speed but punish overconfidence. About how power can exist beyond balance sheets, waiting patiently to be noticed. In the years that followed, the memory of that realization settled into the background of global decision-making. It did not dominate headlines forever, but it reshaped instincts. Investors grew more cautious. Governments grew more alert. The assumption that markets alone could neutralize political power quietly faded. Russia's story became a reference point, not because it was unique, but because it revealed a pattern. Global finance has evolved faster than global understanding. Capital moved at the speed of algorithms, while risk still lived in history, culture, and human choice. When those forces collided, the consequences traveled far beyond any single country. For some nations, the lesson inspired resilience. For others, it exposed vulnerability. And for ordinary people, it reinforced an unsettling truth. Their daily lives could be shaped by decisions made thousands of miles away, by forces they would never vote on or fully see. In the end, the day investors finally paid attention to Russia was not just about one country stepping into focus. It was about the world realizing that power does not always announce itself loudly. Sometimes it waits. Embedded in systems. Ignored until it can no longer be. In the end, this story reminds us that global power rarely disappears. It only shifts, often quietly, beneath familiar systems. The moment investors realized Russia could not be ignored was not sudden. It was overdue. It revealed how modern markets can misunderstand influence until reality forces a correction. In a connected world, finance, politics, and daily life are inseparable. And the forces we overlook today may shape the stability we depend on tomorrow.